What do you think is the hardest part about dividend investing? Most people would probably say it's finding the right stocks. Others would say surviving a bear market, avoiding dividend cuts, or choosing between ETFs like SCHD and VIG. Those are all real challenges. But they're not the hardest part. The hardest part begins just after you make your first investment. Imagine you finally decided to build a dividend portfolio. You open your brokerage account, set up automatic investments. Every month, part of your paycheck starts buying shares of high-quality dividend companies. For the first time, it feels like you're building something that could eventually create financial freedom. Then one morning, your phone lights up, dividend received. You open the notification. Your first payment is $4.83. A few weeks later, another payment arrives, $6.27. You expected that moment to feel exciting. Instead, it barely pays for a coffee. Then the market pulls back. Your portfolio drops. Now your account is worth less than you've invested. Your dividend income is tiny. And a question quietly appears. Did I make a mistake? This is where thousands of investors begin doubting a strategy that has created wealth for generations. Not because dividend investing stopped working, but because it doesn't look the way they expected. The hardest part about dividend investing isn't choosing great companies. It isn't understanding financial statements. It isn't even living through market corrections. The hardest part is continuing to invest while the results still feel too small to justify the effort. Ironically, that's exactly where almost every successful dividend investor once stood. And today, that stage can feel even harder. Social media is filled with screenshots of people earning thousands of dollars every month in dividends. What almost nobody shows you is the beginning. The months when your dividends barely buy lunch. The days when your portfolio is negative. The moments when consistency feels harder than investing itself. So in this video, we'll break down why this stage feels so difficult, what your portfolio is actually accomplishing while it seems like nothing is happening, and why getting through this phase may be the most important step toward building meaningful dividend income. If you enjoy realistic investing breakdowns backed by simple math, take a second to like this video, subscribe to Narrative Finance, and stay until the end. Because once you understand what the hardest part of dividend investing really is, you'll stop judging your progress by today's dividend payments and start seeing the foundation you're quietly building for the future. Let's take a closer look at what those first months actually feel like. Imagine you've been investing consistently for a while. Every paycheck, another contribution, every dividend automatically reinvested. You're doing exactly what every long-term investor tells you to do. Then your first few dividend payments arrive. Maybe it's $4.12. The next month, $8.79. A little later, $16.45. Technically, that's progress. Your dividend income has nearly quadrupled. But emotionally, it doesn't feel that way. Because your brain isn't measuring percentages. It's measuring what those dollars can actually do for your life. $4 doesn't pay for your morning coffee anymore. $9 might cover 1 month of a streaming subscription. $17 won't even fill half your gas tank in many parts of the country. You look at those payments and think, I've been investing for months, and this is all I've earned? That's the expectation almost every new dividend investor brings into the market. Not because they expect to become wealthy overnight, but because they expect to feel progress much sooner than they actually do. That's an important distinction. The disappointment isn't created by the dividend itself. It's created by the gap between what you expected investing to feel like and what it actually feels like in the beginning. You imagined opening your brokerage account and seeing proof that your money was finally working for you. Instead, it feels like you're doing all the work. You're earning the paycheck. You're making the contributions. You're sacrificing today's spending. And your portfolio responds with a dividend payment that barely changes your weekly budget. That's why so many people become discouraged long before their portfolio has a real chance to grow. Not because the income is bad, because it's being judged against expectations that no beginning portfolio could realistically meet. And that's exactly where the hardest part of dividend investing begins. Not in the numbers, but in learning how to stay committed while the numbers still feel too small to matter. Then the market adds the second test. Because it's one thing to receive small dividends while your portfolio is slowly growing. It's another thing to receive small dividends while your portfolio is falling. Imagine you've been investing for 5 or 6 months. You've contributed around $2,500 so far. Your dividends are beginning to arrive, but they're still small. Maybe $7 here, maybe $11 there. Then the S&P 500 pulls back. Nothing unusual, just a normal market correction. Your account drops 7%. Now your $2,500 portfolio is closer to $2,325. You look at the screen and realize something uncomfortable. You've collected less than $30 in dividends, but your portfolio is down $175. Emotionally, that doesn't feel like investing. It feels like you paid money to feel worse. And this is where many new dividend investors start rewriting the story in their head. They think, maybe I bought at the wrong time. Maybe dividends are too slow. Maybe I should have waited. Maybe I picked the wrong ETF. But the truth is much simpler. You didn't discover a broken strategy. You discovered volatility. And volatility is still part of investing in 2026. Whether you own dividend stocks, SCHD, VIG, DGRO, VOO, or individual companies, prices will move. Sometimes down, sometimes immediately after you start. That's not proof that you made the wrong decision. It's proof that you finally entered the market. Almost every long-term investor has a version of this story. The beginning rarely feels clean. It often feels messy. Tiny dividend payments, red numbers, doubt, second guessing. And sometimes family or friends quietly wondering why you didn't just keep the money in savings. But this is exactly why the beginning is so difficult. You have not built enough income yet to feel rewarded. And you have already taken enough market risk to feel uncomfortable. That combination is brutal. Small rewards, real volatility, and no visible proof yet that the system will eventually work. That's the emotional test most people don't expect. And it's also the point where your portfolio is quietly doing something much more important than today's balance suggests. So, if your dividends still feel too small, what is your portfolio actually doing? Much more than most investors realize. Every monthly contribution buys additional shares. Those shares represent ownership in real businesses that continue generating profits, whether you check your portfolio or not. When those companies pay dividends, DRIP, dividend reinvestment, automatically uses that cash to purchase even more shares. Now those new shares can generate future dividends too. It's a quiet cycle. More shares, more income, more ownership. Month after month, your portfolio becomes a little stronger, even if it doesn't feel much different. Think of it like building the foundation of a house. At first, all you see is concrete, steel, and dirt. It doesn't look impressive. It doesn't even look like a home. But every builder knows the foundation determines everything that comes next. A dividend portfolio works the same way. The early years aren't designed to produce life-changing income. They're designed to build the engine that will eventually produce it. And that engine becomes even more powerful when the businesses you own consistently raise their dividends over time. Now you're benefiting from multiple layers of growth. Your monthly contributions buy more shares. Your reinvested dividends buy even more. And many of the companies themselves continue increasing the amount they pay shareholders every year. Whether you invest through individual dividend stocks or ETFs like SCHD, VIG, or DGRO, the principle never changes. The portfolio keeps strengthening, even when the progress is still invisible. And that's why so many investors underestimate the beginning. Because the most important work your portfolio will ever do happens before it looks impressive. The beginning of dividend investing has always been difficult. Today, it may be even harder. Not because the strategy changed, because the environment around you changed. Every day, social media is filled with screenshots of portfolios generating $3,000, $5,000, even $10,000 a month in dividend income. You see videos celebrating financial independence, people showing six-figure portfolios, early retirement, passive income paying every bill. After a few minutes of scrolling, it's easy to feel like everyone is miles ahead of you. Then you open your own brokerage account. Your latest dividend payment is $8.36. The comparison feels brutal. But here's what almost nobody shows. Those impressive portfolios didn't start with thousands of dollars in dividends. They started exactly where you are now. Tiny payments, small portfolios. Months where progress felt almost impossible to notice. What you're seeing today is usually the highlight reel, not the first chapter. Nobody posts the screenshot of their $4 dividend. Nobody celebrates the month their portfolio finished slightly lower than where it started. Those moments are real, but they're rarely shared. That's why this stage has quietly become the most dangerous part of dividend investing. Not because your portfolio isn't growing, because it constantly feels like everyone else's is growing faster. The investors who eventually build meaningful dividend income aren't the ones who never felt discouraged. They're the ones who stopped measuring their progress against someone else's finish line. Instead, they kept measuring it against where they were last month, last year, and the habits they were building for the future. Because the most dangerous moment in dividend investing isn't when your portfolio falls. It's when you convince yourself that nothing is happening, even while the foundation is getting stronger every single month. So what do the investors who make it through this stage actually do differently? Surprisingly, most of them don't spend their time searching for higher dividend yields. They spend their time building a stronger investing habit. Instead of constantly asking, how can I earn another 1 or 2%? They ask, how can I invest a little more next year than I do today? Because they understand something that's easy to overlook. A portfolio doesn't become powerful because of one great investment. It becomes powerful because it keeps receiving fuel. That fuel is your monthly contribution. And over time, many investors naturally find ways to increase it. A small annual raise, a promotion, an employer bonus, a debt that's finally paid off, an employer match inside a 401k, more money flowing into a Roth IRA, automatic investing that keeps buying shares without relying on motivation. Even fractional shares help every dollar stay invested, instead of sitting in cash. None of these changes feels dramatic on its own. But together, they quietly accelerate everything. More contributions buy more shares. More shares produce more dividends. More dividends are reinvested into even more ownership. That's why experienced dividend investors rarely obsess over finding the highest yield. They know that chasing an extra percentage point often matters far less than consistently increasing the amount of capital working for them every month. The investors who eventually build meaningful dividend income usually aren't the ones who discovered a secret strategy. They're the ones who kept strengthening the habit while allowing time to multiply the results. Because in the end, the biggest accelerator isn't finding a better dividend stock. It's making sure your portfolio has a little more fuel this year than it had last year. Then, almost without noticing, something begins to change. Not overnight. Not because you discovered a better stock. Not because you suddenly became an investing expert. Simply because you stayed invested long enough. One day you open your brokerage account. A dividend payment comes in. $128. A few months later, another one. $214, then $387. For the first time, those payments actually feel meaningful. They don't replace your paycheck, but they no longer feel symbolic either. You realize your portfolio just paid for your monthly internet bill. A little later, it covers your grocery shopping for the week. Then one day, you notice something even more important. You didn't get here by constantly changing strategies. You didn't get here by chasing the highest dividend yield. You didn't get here because you perfectly timed the market. You got here because you kept buying ownership in great businesses, month after month, year after year. Now every dividend purchases additional shares. Those additional shares generate even more dividends. And those dividends buy even more ownership. For the first time, the cycle you've been building since your very first investment becomes visible. This is the moment almost every long-term dividend investor remembers. Not because it's the day they became financially independent, but because it's the day they finally stop wondering whether the strategy works. From that point forward, the question is no longer, is this working? It's, what will this portfolio look like 10 years from now if I simply keep going? That's when dividend investing starts feeling less like patience and more like momentum. If there's one idea I hope stays with you after this video, it's this. The hardest part about dividend investing was never learning how dividends work. It was learning how to keep believing in the process before the results felt meaningful. The hardest part wasn't choosing between individual stocks and dividend ETFs. It wasn't finding the perfect entry point. It wasn't predicting what the market would do next. Those things matter. But they aren't what causes most people to quit. Most people quit because the beginning asks for years of consistency, while offering very little emotional reward in return. That's a difficult trade-off. And yet, it's exactly the price every successful long-term dividend investor has paid. The investors who eventually build meaningful passive income aren't necessarily the ones who started with the most money, or the highest salary, or even the best investment knowledge. They're the ones who kept investing while their portfolio was still too small to impress anyone. Because one day, those small dividend payments stop feeling symbolic. The reinvestments begin compounding on themselves. The growing income becomes visible. And you realize something that seemed impossible during those first few years. Nothing was happening slowly. Everything was happening exactly the way it was supposed to. Dividend investing rewards consistency long before it rewards capital. The investors who understand that are usually the ones who stay invested long enough to experience what the beginning was quietly building all along. If this video gave you a new perspective on the hardest part of dividend investing, please leave a like and subscribe to Narrative Finance. If you know someone who's just starting their investing journey, or someone who's beginning to doubt whether it's worth continuing, share this video with them. It might be exactly the encouragement they need, and leave a comment below. We'd love to hear where you are in your own investing journey and what's been the biggest challenge you've faced so far. Thank you so much for watching. I'll see you in the next video.